Welcome back, everybody. Today I thought I'd do a different type of video. I'm on the options subreddit in the weekly Safe Haven thread. This is where people can go to ask their questions and not be fearful of people saying that's such a beginner question and being made fun of, that kind of stuff. So I thought I'd go in here, look at the top 10 or so questions, and just respond to them, and just call it a YouTube video. So going in here, let's go ahead and zoom in. Now the first question is from T3 Chisfun. What kind of premiums can I get with $1,000 in cash secured puts or cash secured calls, 14 DTE with minimal risk? I would be interested in solid stocks. I don't believe in gambling with meme stocks. What I would say is if you only got $1,000, maybe you should work on saving more, build up that account size. The bigger your account size is, the easier it is to do options. With $1,000, if you're looking at cash secured puts, there's not many stocks that are trading around $10 and under that you would want to do. I'm trying to think of ones that I might do. Virgin Galactic, but that's pretty risky and aggressive to begin with. And I'm having a hard time thinking of other ones. When I first started, I did start with Ford, which was a $5 stock at that time, so that was a perfect stock for me to learn with. But $1,000 gives you very limited amount of choices that you can do. Cash secured calls, I'm not sure where you're getting the cash secured call part from, because selling a call is a naked call, because you can't have the cash to act as collateral for when something shoots up to infinity. So I'd stick away from getting away from the cash secured calls unless you're actually buying the shares and doing a covered call. And with 14 DTE, if you were actually wanting an answer for your original question, I'd say you can get like 1% a month pretty safely with theta strategies on any account. So in 14 days, since there's a shorter DTE and theta's higher, maybe that gets bumped up to like 1.25% on a safer area. But again, I suggest that you go ahead and work on growing your account size. I mean, try to get to like 2,000, 2,500 before you start. And then make sure you learn about spreads, because that might be what you need to use as you're using a smaller account. And you can get some pretty insane returns with them. Just try to stay safe. Don't get too aggressive. Even 5% returns are huge, even though dollar-wise it doesn't sound as much. Oh, and you don't like meme stocks, and you don't like Virgin Galactic. So I really don't know what you can tell puts on. All right, next up, Tim Frums. I've got a question I can't seem to find the answer to about stock options. Basically, I'm wondering about leverage stocks and the effect options has on them. Example, I believe the S&P 500 will rise a lot within the next few months. Typically, a call option for the S&P 500 index would work. However, that's not good enough. I want to leverage my position further. How do one go about doing so? I've considered options on leverage index, but I don't know if that will perform the way I'm thinking. Leverage ETFs are considered a daily investment. Holding leverage ETFs over time always results in a loss, with one glaring exception, which will be broke soon enough. So investing in the long term in those is an option. So any insight would be wonderful. Well, Tim, everyone wants to get rich quickly, but you don't need to do that. So it sounds like you really want to bet on the stock market going up a lot. The way I would play it would probably be buying in-the-money calls on S&P 500 and maybe something around like 0.8 delta, which would be a lot of money to hold those. And that'd be a little bit more leverage, but you said you want to be a lot more leverage and go for that bigger home run. You could go out and buy some out-of-the-money options, but realize that theta's working against you if you're wrong. And what makes you so sure that the S&P 500 will rise double-digit % in the next few months? Because if you actually knew that that was going to happen, buying out-of-the-money call options might be the way to go. But I'd probably lean more towards a way of minimizing that extrinsic value, which would be buying in-the-money calls, maybe running zeros. And I kind of agree with you. Stay away from leverage funds until you know more about them. Ambit says, let's say I sell a cover call to Bob. Bob must be from Wall Street Bets on Monday, and after a few days of the underlying trade sideways, I decide to buy to close to lock in a profit. What happens behind the scenes when I buy to close my cover call position? Bob's not the one I'm buying from, right? And it's not like I'm buying someone else's cover call, since I have no position after I buy to close. Very confused on what happens behind the scenes. Basically, the market maker will find you someone to take the other end of that, or they'll take it themselves and settle later with someone else. So they provide liquidity. Basically, all you gotta worry about is your end of the position. You don't have to worry about who's buying or selling your other end. So don't even worry about that. Like it really does not matter. Just focus on what's best for you. So you sell a covered call. It doesn't matter if Bob bought it, a hedge fund is buying it as a hedge, the market maker is using it to get delta neutral, stuff like that. Like it doesn't matter. And whoever bought that other side, not necessarily it's not paired together indefinitely. You're free to close with whenever you want, and it can be done with anybody else or someone else buying into a new position anyway. We're selling to open a position, so you're buying to close yours while someone else is selling to open a new one, thinking it's still gonna go down. So it literally does not matter. There's no connection, no relationship whatsoever. Don't even worry about that. Your mind is better spent worrying about other things. Where can you make the next best trade, and how to get out with a profit. So don't worry about that end of the trade. Just focus on your side, how it affects you. The other half doesn't matter because you'll never see what happens there. Whooping Reno, is that like a Pokemon? So I learned quite a bit now regarding options and how their price is created based on the underlying. Now I want to take it a step further and learn about option strategies combining multiple options of different types. Any book recommendations on these strategies? Try to buy in advance. Well, there might be some good recommendations there. I haven't really read too many books about trading options. I will say that Ally option strategies, if you search for this, they have a nice little guide here that will show you a bunch of different strategies that you can look at and quickly see how they play out depending on which one you're implementing here. And they have it arranged from beginners to pros, which is pretty cool. I'm not sure how they define the different strategies or where they fall into each one. But that's definitely something I say you should look at if you're looking to explore new strategies. It's just a quick visual way to see. And then you can obviously click on them and then learn more about it. So it might be better than a book because it's an interactive website that you can use. Another book I would recommend that I've only started listening to, because I'm actually doing it on YouTube, is Trading in the Zone. And it focuses on the mental aspect of the trading game, which I think is one that a lot of us could use help conquering, because it's very important. Trading options long term. The two most important things I found to be are risk management, which sometimes I botch up myself, and then the mental aspect, because you can't just take emotion out completely. It's tough to do, but that's what you need to figure out how to do when you're trying to trade optimally. So there's my recommendations for you. Am I only paying taxes on net profit for the year? As in, maybe I made $100 one day, but I lose $5,000 the next. I no longer have to pay any taxes on the $100 because of my net loss. Am I correct? Yes, that is correct. So, I mean, I actually got the answer right there. So up to $3,000 of net loss, the remaining net loss is carried over to the following year. If you had $10,000 of gains and $12,000 of loss, your net loss is $2,000. So basically, how much losses you have will cancel out gains that you have until one of them's gone. And if you're still left with a loss, another $3,000 can count against your taxable income, and then the rest will get carried over year to year. If you still come out with a positive, then all your losses just cancel out as much as they can for that year, and then you just have your profit that you pay taxes on. 2 questions from Parks GXX. Selling Iron Condor premium on way outdated SPY options seems like something a Wall Street Bets member would do. Like 2024 max day. Collect premium, profit till 2 years later, and then lose it all then. So if you couldn't simply cover the debt in those 2 years by doing it again, but instead of 1 Iron Condor, you get 2. Get the premium, and then it pays for your debit till 2 years again. Seems like how business works with borrowing money to pay the money they borrowed. Anything stopping me from this infinite money glitch? Basically, what he's saying is what a lot of people think about when they're doing their income trading, where they don't really care about net losses because all they care about is generating income now, because they can continue to roll in the future until that position becomes profitable eventually, which hopefully comes around, but not guaranteed. And if it keeps going against them, what they do is they add more contracts to that position to collect more premium to make up for previous losses and live off of it. And the answer is this works until it doesn't. If you don't have the account size to hold those positions, such as if your broker decides, you know what, we need 100% of the collateral because stuff is going wrong fast, then congratulations, you just blew up your account and you owe a lot of money. So at any time, the broker can change their margin requirements. They could change the buying power that they give you. A lot of things can change to make you kind of cap out. As long as you have a lot of room, this could work. If you have indefinite margin or in a margin amount of infinity, you can do this indefinitely and always make money and not have to worry about losing. But you don't have infinite margin. And sometimes the amount of margin you have can go down. And that's where this infinite money glitch shatters, is when any of those things happen. So trade small. Don't think like this would be my suggestion. There is no free money. If there was, everyone's going to be doing it. And the fact that I'm not doing it means it's not free. The second question, selling Iron Condor for premium for weeklies or daily on SPY. Why wouldn't I be able to set up a stop loss to where at most I lose all the premium I gained for selling one? And if it happened to have a lucky enough day, well, because if you instantly set up your stop loss at the credit you receive, you probably get stopped out immediately. I mean, how many times have you sold an option and you see that it immediately dips because you just change the supply and demand? It dips to negative, so you just get instantly locked out. So that's what's stopping you, is a little hiccup, or even when you first put it on, will make the option price fluctuate just enough. And if you have that at 0, you're going to get stopped out instantly. And a small 1-minute move against you, that will stop you out as well. So don't have stop losses that tight. If you have to play that tight, that's probably not a position you should be putting on in the first place. So find something that you really believe in, that you can sit through a little hot waters for a little bit. Is it okay to start options trading only with bullish calls with an amount of 350? In a cash settled account, sure. But I highly suggest that you save up, build up your capital, and for now, trade in your paper account. Learn how to do options so that when you do have like $2,000 saved up, you know how to handle that instead of trying to get away with playing with 350. Like, the game really does get simpler when you have more money that you can leverage, or it lets you move in and out of positions a lot more smoothly. 350, you're looking at 1 credit spread, and if that goes against you, then you're out of the game like that. So my suggestion again is just save up, build that starting capital a little bit more, and paper trade now. You can still be learning. Just wait until you build up that cash position, just a little bit more than that. Wedding photos MIA. I'm thinking of getting into selling puts, and I'm aware that I have to have enough money in my account to buy 100 shares of the stock if it gets assigned to me. My question is, does this money have to sit on the sidelines in my account the entire time? Like, I can't touch it at all? I guess this comes down to if you're using a margin account or a cash settle account. If you're using a cash account, then the money you need to secure that position has to be just sitting there. If you're using a margin account, then that cash, you can still use that to sell another position as well. In fact, that's what I mostly did. So if I had $100, I could sell a put on a $10 stock, and that'd only use 25% of my buying power. So I could sell another put for $10. So this cash is securing 2 positions. Although if both positions went against me, I wouldn't have enough to secure both. So it's a matter of like risk management here. Like, are you leveraging up a little too much, depending on how much money you have? If you have a larger account, selling puts on smaller stocks seems less risky. But if you have a small account, like, don't leverage up too much because you never know what's going to happen. That kind of answers that one. Next up, Thomas. I've decided on longer-term strategies for options. I've been pretty successful over the few years with options, grinding out about 25% average returns. Nice job. I bought $1,000 or so of $300 weekly puts the day before earnings when Facebook crashed a few months ago and made a killing. but I want to take longer term with options. So my question is elementary. Since I'm quite the amateur, I want to use option leaps. I purchased a NIO calls $65. Dang, bro. Sorry. He purchased January 2024 $65 NIO calls at 65 cents when the price was 19, with the idea that the price of the stock will at least double by then. I understand that theta is not really in play right now and will be as January 2024 approaches. I prefer to play NIL this way rather than tie up capital with ownership. Any thoughts about the strategy and option leaps in general? Not so much NIL trade and my rationale, but the advantages and disadvantages of this strategy. For one, I am fine with people buying leaps. I've done leaps and I've done PMCCs with them. That's my bread and butter with them. I'm not too comfortable buying out of the money calls on long-term positions like that, because like you still need a bullish position for that to be worth something. And you could probably cash out if you do get a move in your favor or IV expands. So hopefully you did that when IV was low. But if you're going to be doing calls and leaps, I'd probably lean more towards buying in the money calls. So something that's like 80, 90 delta, so that a dollar move, you get $80 profit, that kind of thing. And that takes up more capital, which obviously is not what he did here. He's looking for some massive gains if NIL goes up. And I'm not sure NIL is going to hit those levels again. But if he bought like $10 calls on NIO, all he needs is like NIO to stay above 20 to make a positive return. But now he needs a significant move in his favor come 2024 if he's still holding by that time. So I don't buy out of money options unless you are aware of the disadvantages of doing that. Nokia Stonk. Thinkorswim options trading on laptop versus phone. Pros or cons? I gotta say, Thinkorswim options on the laptop is a lot better. You have all the tools available to you. Charting's easy. Like the phone, even though it might be easier to make a quick play, it's just a lot harder to see all the information at one time. So for me, that's the big difference, is that I can see a lot more information quickly on the laptop or on the computer versus a phone, even if the phone has a good design, or even the iPad, same thing. A Diligent Escape. I currently have 20K put and 60K call with the same expiration, and market price of the underlying is 40K. What stock is at 40K? I don't understand why the price of the put is a lot lower than the call, despite IV on the put being higher than the call's IV. Assuming normal distribution, the call and the put should be equally priced, except that the IV of one is higher than the other, in which case that option would have a higher price. So in this scenario, I just want the put to have a higher price, as it is higher IV, not the call. Have we got this relationship between IV and price correct? Dude, it comes down to the delta of the options that you're talking about. That will significantly impact the price of the option itself. And then the market tries to price in whether or not it thinks it's going to go up or down as well. So there will be market skew based on like the feeling that the market's going to have. Then it will also affect the balance. Like it's not going to be 100% perfect. And I hope that helps you, but yeah. So let's make this one be the last one. So Mama didn't raise, well, I'm not going to say that on YouTube. So the stock price is $10. If I decide to sell a put option at $10 for $5.20, premium collected is $1.50, so $150. B, if I decide to sell a put option at $25, premium collected is obviously more, well, because it's in the money call or put. In the event that the stock price is $9, I would gain $50 for event A, and I would lose $60 for event B. Event A's max loss is $850. Event B's max loss is $960. In the event that the stock is at 11, I would gain 150 from A, and I would gain 140 for B. In the event that A's is 150 and B's is that. The $9 difference doesn't seem that risky. The potential gains made in B, the stock price doesn't necessarily have to be higher than the strike chosen to be profits. My question is, why would someone choose to sell event A over event B? Uh, well, quite frankly, because a lot of people don't want to manage in the money options, and I mean that's basically what I think it comes down to. The out of the money puts take a lot less collateral, so you might be willing to sell two $10 puts versus one $25 put. And if that's the case, now you're making 300. That could be relatively safe versus the potential 15, 40 if the stock price more than doubles in less than a month. So the percent chance of this happening is so slim that I wouldn't do it. Now, if you're feeling extremely bullish on a stock and you want to sell a slightly in the money put, I've done that before to get that extra premium to act as a hedge. Like that's totally acceptable. But don't just look at the max profit potential when trying to choose your strike price. Look at what price you'd be willing to own the stock at would be what I'd be looking at. Well, guys, I think that's going to wrap this up. I hope this was an interesting video for you. Really got to see some questions from some other people that might be beginners, and hopefully you can see my thought process on how to answer these questions, and maybe you learned something. If you have a better suggestion with how to answer these questions, go ahead and leave a comment below. I'd love to start a discussion. Have a happy Easter, and hope you guys have a good weekend and enjoy your time.